Most people think the $10,000 rule is the problem. It isn't. The rule is just the door. What's behind it? That's what nobody is talking about. Let me explain something that your bank will never put in writing, something that financial advisors gloss over, and something that the federal government has quietly expanded over the last decade without most Americans ever noticing. Because right now, as you watch this, there is a surveillance system built directly into the banking infrastructure of this country. And if you've ever moved money the way most normal, law-abiding people do, you may have already triggered it. Here's what everyone knows. In the United States, banks are legally required to file what's called a currency transaction report, a CTR, anytime a customer deposits or withdraws $10,000 or more in cash in a single day. That report goes directly to the Financial Crimes Enforcement Network, a division of the U.S. Treasury, better known as FinCEN. No warrant needed. No suspicion required, just the number. $10,000 and your bank becomes a government informant, automatically, instantly, and without telling you. Now, most people hear that and think, fine, I'm not moving that kind of cash, I don't have anything to worry about. And that's exactly where the danger begins, because the law didn't stop at $10,000. Congress saw people figuring out the threshold and adjusting their behavior, making deposits of $9,500, $9,800, $9,000, staying just under the wire. So in 1986, they passed a law making that adjustment illegal. It's called structuring. And under federal statute 31 U.S.C. 5324, it doesn't matter if the money is completely legitimate. It doesn't matter if you earned every single dollar of it. If you deliberately break up transactions to avoid triggering that $10,000 report, you have committed a federal crime. The penalty is up to 5 years in federal prison. And here is the part that should make your stomach drop. The government does not have to prove you did anything else wrong. The structuring itself is the crime. But even that isn't the real danger. Not yet. The real danger is what banks do before the $10,000 threshold is ever reached. Hidden inside the Bank Secrecy Act, the same legislation that created the CTR requirement, is a second reporting mechanism that almost nobody talks about. It's called a Suspicious Activity Report, or SAR. And unlike the CTR, which has a clear dollar trigger, a SAR can be filed on any transaction of any size for any reason your bank deems unusual. Your bank files it in secret. You are legally prohibited from being told it was filed. And once it's in the system, it doesn't go away. What counts as suspicious? That's where this gets deeply uncomfortable. Transactions that are inconsistent with your normal account behavior. Large cash deposits followed by quick withdrawals. Frequent transfers to accounts your bank doesn't recognize. Paying off debt in cash. Depositing cash from what a teller decides looks like an unusual source. The criteria are broad, subjective, and almost entirely at the discretion of the institution. What this means practically is that the $10,000 rule, the number everyone is focused on, is almost beside the point. The system is watching everything below it too. And now, the system is getting worse. Over the last several years, FinCEN has dramatically expanded its data sharing framework. Banks now communicate with each other through information sharing programs authorized under Section 314 of the Patriot Act. That means a flag on your account at one institution can quietly follow you to another. New artificial intelligence screening tools are being deployed across major financial institutions to identify behavioral patterns. Not just individual transactions, but the rhythm of how you use money. How often? At what times? In what amounts? This is the system that most people don't know exists. And this is the system that millions of normal Americans are walking into, blindly, every single day. Now, I want to tell you about someone we'll call David. David is a small business owner. He runs a landscaping company. His clients, many of them homeowners and small property managers, pay him in cash. It's not unusual for his industry. He's been doing it for 11 years. He's never missed a tax payment. He has no criminal record. He's never done anything wrong in his life. But 8 months ago, David started getting nervous about keeping too much cash at home. So he started making more frequent trips to his bank, smaller deposits, more regular, tidy, organized, exactly the kind of pattern that put him directly in the crosshairs of a federal investigation. And what happened to David next is something you need to understand, because the first mistake he made wasn't at the bank at all. David's first mistake wasn't the deposits. It was the silence. He never told his bank what he did for a living. He never mentioned that cash was the primary currency of his business. He had a personal checking account, not a business account. And every week he was walking in with envelopes of cash, depositing amounts between $4,000 and $8,500, never the same number twice. He thought he was being responsible. He thought he was being careful. He had no idea that to a bank's compliance algorithm, he looked exactly like someone trying very hard not to get caught. Within 6 weeks of his new deposit routine, His bank filed a suspicious activity report. He wasn't informed. He didn't receive a letter. His account kept working normally. But somewhere inside a federal database, David's name now had a flag next to it. And 3 months later, when a routine audit of SAR filings cross-referenced accounts in his region, his name surfaced. Federal investigators requested his full transaction history going back 4 years. His account was frozen while the review was conducted. And for 61 days, David couldn't pay his employees, couldn't cover his equipment lease, and nearly lost the business he had spent over a decade building. He was never charged with a crime, but the damage was done. David is not an isolated case. According to data from FinCEN, U.S. financial institutions filed over 3.6 million suspicious activity reports in a single recent year alone. That number has increased every year for the past decade. The overwhelming majority of people named in those reports are never prosecuted. But prosecution is not the only way this system can destroy you. Consider Maria, a nurse. She had been caring for her elderly mother for 3 years, and her mother, a woman of a different generation who deeply distrusted banks, kept her savings in cash hidden in her home. When her mother passed, Maria inherited roughly $40,000 in physical bills. She deposited it over several weeks, careful not to overwhelm her account, thinking she was being considerate. She was not told that depositing inherited cash in increments is one of the most common structuring patterns federal guidelines flag. Her bank reported her. The IRS opened an inquiry. She spent 14 months and nearly $22,000 in legal fees proving that the money was legitimately inherited. The government eventually closed the case. Her savings, however, were almost entirely gone, not seized, but spent defending herself from suspicion she never anticipated and never deserved. Then there's James, a freelance contractor who received a large payment from an overseas client, a legitimate business transaction fully documented. He wired the funds into his personal account because he didn't yet have a business account set up. The international origin of the wire, combined with the size and his account's prior low activity, triggered both a SAR and a separate review under OFAC, the Office of Foreign Assets Control. His account was frozen for 47 days. His rent check bounced. His credit score dropped. The client relationship collapsed. All because the structure of a normal payment looked to an automated system like something it wasn't. This is the pattern. Normal people, normal behavior, catastrophic consequences. Not because they did anything wrong, but because they didn't understand how the system interprets what right looks like. So let's talk about what you actually do. The single most powerful thing you can do right now, before any large deposit, before any change in your financial behavior, before you move money in any amount that feels significant, is talk to your bank. Not a teller, a banker, a branch manager or business relationship officer. Tell them what you do. Tell them where your money comes from. Tell them if your income is seasonal or cash-heavy or irregular. Ask them to note it in your account profile. This one conversation, documented internally, is often enough to prevent a SAR from being filed in the first place, because the transaction no longer looks unexplained. Context is the antidote to suspicion. Second, and this matters more than most people realize, use the right account for the right activity. If you run a business, even informally, even part-time, open a business checking account. The compliance standards applied to business accounts are calibrated differently. A landscaper depositing $7,000 in cash into a business account looks completely normal. The same deposit into a personal account with no business designation looks like a problem. Third, document everything. Keep records of where your cash comes from. Invoices, contracts, written payment confirmations. If you ever receive a large cash payment, write down who paid you, when, why, and how much. If that money ever enters the banking system and a question is raised, your documentation is the difference between a 60-day nightmare and a 30-minute conversation. Fourth, if you are planning to deposit a large amount, inheritance, settlement, business proceeds, anything above $5,000 in cash, consult a CPA or financial attorney before it hits your account. Not after, before. The cost of 1 hour of professional guidance is a fraction of what it costs to defend yourself once a flag has been raised. The final rule, and this is the one to remember, is this. The banking system was not built to assume you are innocent. It was built to report first and ask questions later. That is not a conspiracy, that is the law. And the only people who consistently navigate it without damage are the people who understand it. You are not being watched because you are suspected. You are being watched because the system watches everyone. The question is simply whether your financial behavior is legible to that system, whether what you do makes sense in a language the algorithm understands. Make it legible, document it, communicate it, and never assume that doing nothing wrong is enough to protect you. Because in this system, how you do something matters just as much as what you do. Your money is yours. Keep it that way.